With strong rumours growing of the likes of SpaceX, OpenAI and Anthropic all launching on the stock market this year in an IPO, there is growing hype on social media that it's time to get in now, otherwise you're going to miss it forever. But actually, if you look at the history of IPOs over the last few years, it might not be quite such a happy tale. So if you want to know what this IPO hype and boom mean for you, your money, your investments, and how and if you should get involved, and also why, then stick around because this is the video for you. I'll explore how individual IPOs can actually work for retail investors, how they'll impact your overall index fund investing, also a disciplined, data-driven core satellite portfolio structure that can help you get involved in some of these big trends without gambling all of your hard-earned money away. I'm Zoe and this is my channel Words on Wealth, where I break down key investing ideas, terms and headlines to make you a more confident investor. So let's start with the truth about IPOs. IPO, for anybody that's unaware, simply stands for Initial Public Offering. And it's the first time that shares become publicly available on a stock market. So prior to this, they have been a company that has been growing, but only accessible to private investors. Now, once they list on the stock market, this means all sorts of things. It means that there's higher levels of regulation required in terms of reporting, but it also means as well that more people can get involved in their investing. Now, as I say, prior to the IPO, the company has still been growing. It's not the first time that the company's ever existed, but rather the first time that it's become public. So before this, it's been the likes of venture capitalists, maybe big banks, but other private investors that have really pumped money into the company and likely therefore enjoyed the vast majority of the growth, albeit with higher levels of risk at that stage. Now, they may still continue to own part of the company when it does get listed on the stock exchange. Just because a company lists on a stock exchange and makes some shares available doesn't mean that their entire company is up for purchase. Rather, it's likely to be a relatively small chunk. You can always see how much of a company is up for listing because they'll normally put it in the documents that have to go with the initial filing with whichever stock exchange it is that they're listing on. Now, in order to work out how much shares are worth, there is a huge process that takes place behind the scenes, carried out by the likes of investment banks who work out and value the company. And then they decide how much the share is worth and how much, therefore, you and I are going to be able to buy it for. But this is a huge marketing event. It comes with a big retail buzz. Those investment banks will likely be creating a lot of hype around the event because ultimately they want investors to get involved on that IPO date, which is why we're all talking about the likes of SpaceX, Anthropic, OpenAI and many others this year because people are excited about it, and that's a deliberate marketing move. Some major IPOs from the last few years that you might be aware of that haven't been quite so successful are the likes of, firstly, Allbirds and Birkenstock, both shoe companies. Kind of a coincidence, but hear me out. Allbirds are a sustainable trainer company, or at least they were. When Allbirds listed in 2021, they saw their share prices shoot and then immediately flop. And what this has meant is a few years of turmoil and difficulty, and eventually leading them to pivot their shares towards an AI model. Who knew that sustainable shoes could become that? Birkenstock is, of course, the very famous German sandal maker that also listed a little bit later in 2023. Now, what happened to Birkenstock was relatively similar. There was a lot of hype, a lot of excitement, their share price boomed on day one and then plummeted again afterwards. It's since evened out, but it's certainly been a rough ride for retail investors who got involved at that initial stage. Some other notable big tech ones were the likes of Deliveroo, which was dubbed to be one of the biggest flops on the London Stock Exchange ever. In fact, Deliveroo fell by 26% on the first day after IPO and has since been acquired by the US firm DoorDash. If you had have bought shares on the first day when they were valued at 390 pence, you would have made a significant loss as the acquisition resulted in just an 180p value of each and every share. And then a final tech company in the likes of Peloton also saw a tough time. Not quite off the back of their IPO, where they saw great success when they launched in 2019 and then into 2020 as the world, kind of conveniently for their business model, went into a global pandemic. But since then, they remain an ongoing vision of kind of how bad that IPO situation can be. These are just examples of big names that you might know, but actually when looking back historically, IPOs underperform the broader market by around 15 to 20%. That's not a small figure for me and for you potentially looking at this as an opportunity that is exciting to get involved in and that could really boost your portfolio. because actually a 15 to 20% underperformance of the broader market, not necessarily a loss, but rather just you could have done better by remaining in other index funds, is not something that necessarily most people would seek out. Which brings me on to the point about index funds and ETFs. Just as a quick recap, an index is a list of a certain section of the market. There are creators of indexes. You might be familiar with the likes of S&P, for example, and all of these sell their indexes to major banks, who then create the ETFs and index funds that follow these indexes. Now, normally what we see is that these indexes are relatively clear. It's things like the S&P 500, aka a measure of the 500 biggest companies in the US. We've also got, for example, the FTSE All-World, a measure of many, many different stocks across the globe, and the FTSE 100 here in the UK. Of course, many other nations also have them, from the ASX 50, the Australian index of the 50 biggest companies there. There is also, of course, the Euro Stoxx 50 and the Euro Stoxx 600, amongst others. Now, there is rightly growing fear that within index funds, particularly the S&P 500, we're seeing ever more concentration risk, aka the companies that are the biggest on those stock markets and therefore within those indexes are really dominating and reducing the overall diversification that can be offered by that fund, because everything is just focused on more or less some of the key names. I'm talking the Magnificent Seven, some of the biggest tech companies out there. So what happens if we see these mega IPOs from SpaceX, Anthropic, OpenAI, and they drop into our indexes and our index funds, our ETFs, our strategy really quickly, adding ever more concentration risk? There is some good news to this, because there are some rule changes that we're seeing that I'm not going to get into in today's video, but crucially, most companies have to pass certain strict regulatory hurdles to be included in an index. It doesn't just happen straight away. So, for example, they have to have deep market liquidity. They have to have 4 consecutive periods of positive gap earnings. So even if we see SpaceX or Anthropic launch tomorrow, unlikely, but later in the month, later in the year, they won't be filtering into your index fund that is following the S&P 500 for quite some time, because it will take time for that profitability to be achieved, and it will take time for them to reach the relevant market cap weighting that is also needed to be introduced into the index. So that's the kind of worrying part cleared up, in terms of they're not going to just come in, dominate and cause ever more concentration risk within your index. But what if you do actually want to enjoy a little bit of these themes? Because we've spoken about the potential risks of getting involved in the IPO and how it's not super positive. And the good news is that that's not necessarily going to negatively impact a strategy that is focused on ETFs. But what about taking on board some of those ideas? This is where I talk a lot about the core satellite method. The core is basically made up of those index funds or ETFs that we've just touched upon. They kind of do their thing, tick over, and generally help to balance the risk within your portfolio. It forms around 70 to 80% of your overall portfolio or investments. Now then, with the remaining 20 to 30%, we fill them with what we call satellites. And these satellites are where things can get fun, funky, and interesting. So within these satellites, some may choose to throw in the specific IPOs that are there with a longer term view in mind. But for many, opting for this IPO choice, whilst we've just discussed, could be way too high risk and frankly not something that they want to get involved in, which I totally get. I'm all for a more fund-based approach that just balances diversification and avoids some of those higher risk games and gambles ultimately that can be taken with the likes of An IPO, an unknown quantity. So rather than going for the individual stocks, you might follow what we call thematic ETFs. These are ETFs that focus more on a specific theme or topic and are a little bit less diverse in their nature than something like an all-world or something like even an S&P 500, but they give you exposure to some of the key themes that these IPOs, for example, are really exposing at the moment within the stock market. So if, for example, you want to gain exposure to AI, firstly, what you might consider is something like a semiconductor ETF, or indeed an AI-specific thematic ETF. Secondly, if you're looking at SpaceX and thinking it could be a great idea and want to get involved in the space race, you might consider a space-specific ETF. And yes, believe me, they do exist and they are out there. What these have exposure to is things like various different satellite imagery companies globally, as well as component manufacturers and the launch providers themselves. Now, it might not be that SpaceX drops in there straight away, but you will hopefully gain exposure to the overall sector and the hype that accompanies it. Some other key ideas of sectors that we're seeing as up-and-coming areas that you might want to consider throwing into your satellites are the likes of defence as well. With ever-growing geopolitical tensions, this is an area that many are investing into. Equally, we're seeing the likes of clean energy really take off as a sector. Not least of which because AI is booming, and that is requiring ever more water cooling systems and various different ways to make sure that the data centers that are running the AI are clean and actually sustainable into the future. There's no guarantees, but it's certainly something that is piquing a lot of interest of investors. And last but not least, the likes of physical assets have become ever more thematic and introduced as many into their satellites. Some even have it within their core. The more niche ones outside of the likes of gold and silver may be thrown in. I'm talking things like lithium, nickel, other components of major tech areas such as what goes into semiconductors are becoming more and more interesting to various investors who want to gain a little bit more risk in their portfolio, likely through these satellites, in a way that is still manageable. It also helps further to gain exposure to that AI boom without directly being involved in the companies that may well open themselves up to great levels of risk, such as chasing stock market hype is not something that's new. It's something we've seen for many, many years. And with some of these IPOs coming out of the likes of SpaceX, Anthropic, OpenAI, they are some of the biggest that we've ever seen in history. I get it, the hype is there. But for me, the potential for flop is really quite large. So I'll be letting the institutional investors play that game whilst taking a step back and using the likes of the themes that are coming out of some of those major IPOs to add them into my satellites and let the compounding do the heavy lifting within my portfolio whilst the core does its thing and ticks over. Ultimately, for me, building long-term and real wealth is about being disciplined, not just about jumping on the back of the latest thing. If you want to know more about how I build my core, I have other videos about this, including my 5 ETFs that I would have if I was reinvesting in 2026. Do make sure that you like, subscribe, and give me a follow if you're enjoying this as well. See you for the next one.